Hello traders, welcome to a new video on the channel. So today we're going to be talking about continuing with our course regarding market structure trading. Okay, if you haven't done so, please make sure to subscribe so you don't miss out on any content. And I recommend you go back and watch the last two videos that I made. First video was an introduction to basic market structure principles. Second video was bullish market structure breaks, break retest and pullback. This video is going to be part 3 and is going to be pretty similar to the last one, except now we're going to focus on bearish structure breaks. So we're going to go over examples of what we consider a break in a trend to the downside and how we can use market structure to get in either on a retest of the broken swing or on a deeper pullback to go with the trend. Okay, so let's go over a basic diagram. So what do we consider a bearish market structure break? Okay, so when we're in a bearish structure, we're obviously, like, if you're in a bearish trend, we're expecting price to be making continuous lower lows and lower highs. And one of the requisites is we want to see previous swing lows being broken to the downside. Now, if we have a market and let's say it's coming up, like in this example, the moment that a previous swing is broken, that's our first sign that we're having a possible change in market structure. So we had this higher low here coming in on this trend, higher highs, and then right here on this break, we've printed a lower low. So this is our first confirmation. When we get a pullback, either we get a break retest or we get a deeper pullback and then a move down. When we print a lower high, this is our second confirmation. You know, some people, if you want to be more conservative and make sure that the trend is probably more likely changing, you can wait for a double confirmation of a lower low in this case and a lower high. Or what we're going to talk about here is how we can get in immediately after our first confirmation on the break. And as you can see, one of the first scenarios, especially if it's a strong change or shift in trend, is that markets is just going to pull back into the previous broken swing. And again, you know, this might have several swings here, like it can be like this, but we're just going to take the most obvious and prominent level. Sometimes also we may have multiple hits on this level, so then you also want to just choose the level that has the most confluence of hits. And as you know, this is pretty much basic support resistance principles, where if you have support and it's cleanly broken, then you can expect resistance from the other side. So that's the first scenario. The second scenario is what we call market structure break bearish and a gap fill retest. So in this case, we have our trend coming here, we have a higher low, and then usually, you know, before price makes an impulsive move that breaks a previous low, there's going to be some kind of cluster or consolidation of candles here. Maybe you're going to have to, you know, let's say this is a daily chart. Maybe you're going to have to go down into like a 4-hour chart or even a 1 hour to just get like a clearer picture here, get more detail into this area. But you'll often find a cluster of candles here. So what we want to do is just look to mark off, in this case, the last cluster of candles that we had pushing up before we had the impulsive move down that broke the previous swing. And this has many names. Some people call this a supply zone. Some people call this a supply block, a bearish order block, a resistance area. You know, it has many names. But the basic principle is you want to just look for the cluster of candles that led into the impulsive move that made the shift. And in this case, we have our first sign here, confirmed break below the previous swing. And then in this case, you can see we had a deeper pullback. In this case, we did not just come back and test the broken swing, but in this case, we pull back deeper into the last cluster, filling in the gap that we left in the impulsive move. This is a common gap, which are gaps that are filled very quickly. Is one of my favorite things to use. I have a whole video on this on YouTube, and I go into a lot of details in my courses on all the trading strategies that I use in Confluence for this. And then if you're looking to trade this, then obviously your invalidation or your stop loss is going to go just behind the cluster that caused the impulsive move. So the good thing with this kind of pullback is that it's easier to define your risk, because what happens, let's go back into the last slide. Like if you go here, you know there's a chance market will reject here, but you can probably get a pullback all the way into here and then go back down. And so if you're looking to enter here, where do you put your stop loss? Well, obviously the logical place is behind the last significant swing. So as you can see, unless you're taking, a big swing trade that you expect price to go down a lot, this is a pretty wide area usually for a stop loss. So you just got to make sure that your risk reward on the trade is good, and just take, trades accordingly. So in this case, with this, instead of going in here, market went up, and then if you look to get short on the cluster here, your invalidation is right here, and now you can see your risk is a lot more defined. You're risking a lot less, and your potential reward is going to be a lot bigger if this trend actually reverses and we continue pushing down. So as you can see, you just get a nicer, a better yield when it comes to the entries that you can take. Okay, let's just go into TradingView and just look at a few examples. I mean, you can go back on your charts, and I recommend practice just back testing it, go manually drawing and analyzing. But you can see here several examples. I hadn't actually drawn this one, but you can see there's a very obvious resistance area here. So we had a very big swing. We had one here, but you can see we actually did not fill this in. We did not pull back into here. But then here we broke this swing, break market structure down, and then we pull back a little. First, we did get a pullback into the swing point here. And this is another thing you're going to see. Sometimes you're going to have the break, and you might pull back here, but then you might pull back deeper and then go. Like you can see in this example here. We had a break here. We pull back into the swing low and rejected, but then we pull back into the bigger area here, the swing low, with all this confluence of support broken into the supply block, and then we go from here. Then you can see below here as well, we had all these candles here. We had a little gap here as well. We had an immediate pullback into the lower swing, but then we come right back into the more confluence of candles and we reject. But in this case right here, you can see we had a shift to the upside, which I talked about this last week, so I don't want to repeat bullish structure breaks, but it's the same principle to the upside. And then you can see right here on these ones that I marked, you have your clear, higher highs, higher lows. Here you made a double bottom. This has not been broken yet. Remember on my first lesson I said, if we had a solid candle closing here, then this is broken. But if we see that market is just wicking a little below and closing back above, then it's not officially a market, a structure break in the time frame that we are trading. Because obviously, I mean, this is a daily chart. If you start going down into like a 1 hour or a 15-minute chart, then you probably had a candle close below this line. But we want to focus specifically on whatever trading time frame we are using. Okay? And so then here you can see sometimes the swing low coincides with our supply block as well, or our resistance or bearish order block or whatever. And then in this case, you can see we pull back into our block and then we just went from there. Now over here, you can see we had this one is on a lower time frame. I'll show you this one in a second. But then here, you can see we have this swing low. We barely break it. And then right here, we broke it. And then you can see in this case, we break below, come back up. And then in this case, we go into the last cluster here. You can take this, or you can even just take this one, which is the one that led to the impulsive move down. And then you can see we came almost all the way up through here, and then we went down from there. If we go into Bitcoin, another example here, this is very recent. This is currently where we are, the current price action. But you can see here we had a big dump. Then we started just sort of going up like a rising wedge pattern, making higher lows. And then right here we had this swing low. And then on this candle, we just broke through here. So then I just marked the consolidation, the cluster of candles prior to the move. You can see we tried to pull back here. We didn't quite get there, went down. And then right here, we came right back up into the two previous swings and into the supply area. And then we break down from there. And then right here, similarly, a lot of confluence, lots and lots of support, broke through. So now what am I watching here? Where I'm watching either let me actually extend this, because as you can see, we have a lot of confluence here, a lot of pretty much all this we can consider as like the swing low, or basically the broken support. So what I'm watching is potentially pull back into here and rejection, or a deeper pullback to fill in this gap into the supply, and then rejection. And if we're gonna try to go short, let's say here or here, our stop loss then will be above 21,500, this swing high. If we would come down here and break above, then we shift into bullish market structure break, and then we make a line here, and then we would look, for a retest here, or possibly like a deeper pullback into the cluster that led to the break, etc. Same principles, but in reverse. And the last one, just an example here on Euro. And we can go here on the higher time frame, on the weekly time frame. And a lot of this, usually this structure breaks will look a lot cleaner on the higher time frames. Like if you're doing this on like a 5-minute chart, 15-minute, it might look a little bit messy. but especially this is very useful if you're doing swing trading. If you can't be on the charts all day, then you can take, you know, a daily, 3-day, a weekly chart, and this will give you great levels for swing trades. Of course, this works on lower time frames as well. You just want to highlight the level, and then you can go on your intraday charts and then just look, you know, for bullish or bearish patterns around the broken swing levels or into the deeper pullbacks. So you can see here, swing low, broken, retest into the swing, swing low, broken. Here we did not quite get into it. New swing low, broken. We pull back into it. New swing low, broken. Here we almost pull back into it. And again, this is a weekly chart. You know, you're probably not going to be taking trades of a weekly chart because you're not going to get a lot of trading signals. But if we mark off this area and we want to watch, for example, what happened here, because we have this swing low, but we can see there was something here. So if we go down into a daily chart, let me just mark off this on the daily. Okay, so we're focusing on this swing that I have highlighted here. And what do you see? On the weekly chart, this was the obvious swing low. But if we go down on the time frame, look at this area here. This is a very clear swing low. So in this case, you can go down into your daily chart and just do like this and refine your level here. And you can see how we had breakdown here, left this gap, and then we pull back and we had just a great retest. And this is right in line with our resistance, bearish order block, etc. And then we just go from there. Okay. Right over here, you can see we barely missed this here as well. We had this little swing right here, and we almost touched it right here, but just missed it. Okay. And that's why also when you have a level like this and you have a candle and a wick right behind it, this level has already sort of been retested. Like if we go into a lower time frame still, then you can see that that level already had a little retest. But as you can see, if you just go on the lower time frames, then you can refine these things even further. For example, this is a 4-hour chart, and now you can see that we had a smaller swing level here. And if we take our line tool, you can see that price went back right into the gap fill on the 4-hour chart. But again, well, this is going into multiple time frame analysis, etc., which I've got videos on that and guides, etc., on my course. But the basic principle, again, we're just talking about bearish market structure breaks and the two possibilities we're looking for, which will be either a break and a broken swing retest, meaning we pull back into the broken swing level. But again, this gives us a wider risk area, so we need to be clear on where to define our risk there if we're going to try to go short. And second, bearish market structure break and a gap fill retest, meaning we have a deeper pullback into the broken swing, and then we're just coming to the last cluster in our trading time frame, filling it in, and then we have a clear invalidation just behind our supply area. Okay, so that's pretty much it for the video, guys. Thank you all for tuning in. Hope you had a great week, and make sure to subscribe, hit thumbs up. Check out my course page for more information on all my courses. Again, this is something that I use in all my trading, with confluence from volume profile, order flow tools, etc. that I teach in all my courses. Okay, take care, and I'll see you in the next video.